Welcome back to the Deep Dive. It is Saturday, January 31st, 2026, and wow, can you believe we are already closing the book on the first month of the year?
It feels like the year just started, but the markets clearly didn't get the memo to ease into things. It has been a sprint since New Year's Day.
It really, really has. And if you've been watching the news or, even just glancing at the headlines on your phone while you have your morning coffee, the financial world feels a little bit, well, louder than usual right now.
Louder is a good word for it. It feels like there are these two massive competing narratives just screaming for your attention.
Exactly. Screaming. On one hand, you have this absolutely enormous, almost science fiction level infrastructure build out happening in artificial intelligence. I mean, the numbers we're seeing for capital expenditure, the money being spent on data centers and chips, they're eye-watering.
Truly astronomical.
Yeah.
And then on the other hand, you have the cryptocurrency markets, specifically Bitcoin, doing what they always seem to do.
Which is swinging wildly.
Swinging wildly and making people wonder if they're missing out on becoming overnight millionaires. It's that classic FOMO, the fear of missing out, battling against the fear of losing everything.
And for our listeners, particularly those we call the learners, and especially for the U.S. seniors tuning in who are looking at their nest eggs and thinking about stability, income, and, legacy, this noise can be incredibly confusing. It's paralyzing.
It really is. You see one headline that says Bitcoin hits new high, and the next says tech giants to spend $100 billion. What are you supposed to do with that?
That's the listener I really want to focus on today. You're retired or you're getting close. You've worked your whole life to build this nest egg, and it really begs the question, where do you put your money? Where does the safety lie? And maybe more importantly, where does the real value lie here in 2026?
That is the mission for this deep dive. We're going to try to cut through that hype. We have a massive stack of sources today. I mean, we're analyzing reports ranging from 2017 all the way to last month. We've got stuff from BlackRock, Winthrop Wealth, some really interesting academic papers from Syracuse University.
I saw one of those comparing Bitcoin to Beanie Babies.
Yes, that one. We have technical analysis from Patent PC on intellectual property strategies, market data from late 2025, and a really critical 2025 comparative study called Productive Assets versus Value Absence.
So our goal is pretty specific. We want to really dig into this digital gold versus digital oil debate.
That's the core comparison. We're going to try to debunk this myth of Bitcoin as a safe haven for seniors and explain why digital oil, which is really what we call the data and the intellectual property owned by big tech, is the true productive asset of this decade.
And we are going to get practical, too. This isn't just theory. We have a really fascinating comparison coming up later between some very popular ETFs, specifically QQQ versus VGT.
Right.
And I think listeners are going to be shocked to find out that one of the most popular tech funds out there is actually missing two of the biggest tech companies in the entire world.
It's a classic trap in index investing that a lot of people fall into. But, before we get to the solution, we have to really understand the problem.
Right.
And that problem starts with understanding what you're actually buying when you buy Bitcoin versus what you're buying when you buy a share of a big tech company.
So let's unpack this. Let's start with part one, the Bitcoin reality check. Because the narrative for years, especially the one pitched to older, more cautious investors, has been the dollar is inflating, the government is printing money, you need a store of value, you need digital gold.
That's been the sales pitch.
Yeah.
And it's a compelling story. You can't deny it. It taps into a very real fear. But when we look at the data, and again, we're looking at a comprehensive data set from 2015 all the way through to now, that store of value argument shows some very, very serious cracks.
Okay, so how so? Walk us through the volatility first, because that seems to be the most obvious issue.
It's the first thing that jumps off the page. I mean, let's just define our terms. A store of value is supposed to do what?
Preserve your capital. Be a safe place.
Be the bedrock, the thing you own that lets you sleep at night. But according to the data from both Winthrop Wealth and BlackRock, Bitcoin's annualized volatility sits somewhere between 70% and 90%.
70 to 90. Okay, that sounds high, but put that in context for us. What's a typical number for the S&P 500?
So the S&P 500 in what most people would consider a fairly volatile year is usually around 15% to 20%.
15 to 20.
So you're talking about an asset that is on average 4 to 5 times more volatile than the broad stock market. For a senior in retirement, that is a roller coaster that can induce Well, nausea, to say the least.
It's a white-knuckle ride you don't want to be on when you're supposed to be enjoying your golden years.
But the scariest stat isn't even just the daily up and down. It's what's called the max drawdown.
And that's the measure of how much it drops from the absolute peak to the absolute bottom in a given period, right?
Exactly. And for Bitcoin, we have seen drawdowns of negative 83%.
83%. Just let's pause on that. Imagine you have a $100,000 portfolio.
Right.
In a worst-case scenario with that kind of asset class, you could be looking at it shrinking to $17,000.
And the recovery time, just the time it takes to get back to even, back to that $100,000, can be 2 to 3 years.
And if you're 75 years old, 2 to 3 years is an eternity to wait just to get back to zero. You might need that money for medical bills, for travel, for just living expenses. If you have to pull money out when it's down 80%, you're locking in a catastrophe.
Precisely. That's called sequence of returns risk, and it's the #1 enemy of the retiree. It's the risk of having to sell low early in retirement, which permanently damages your portfolio's ability to recover.
It's a hole you can never dig out of.
Never. And it gets worse. We also have data showing that since 2015, Bitcoin has averaged 3.4 bear markets per year.
Wait, a bear market is usually defined as a drop of 20% or more from a recent high. You're saying it does that 3 times a year?
On average, yes. 3 to 4 times every single year, this asset crashes by at least 20%. Imagine trying to plan your withdrawals around that.
You can't. It's impossible. So it's not a store of value. It's a store of anxiety.
I like that. A store of anxiety.
Uh-huh.
That feels very accurate for anyone who has watched the charts lately.
But let's go deeper than just the price swings. Because the bulls will say, yeah, it's volatile, but it's the future. So let's talk about intrinsic value. We have this fascinating paper from Syracuse University that applies the Graham test, named after Benjamin Graham, the father of value investing. How does Bitcoin hold up against that?
It holds up very, very poorly. I mean, Benjamin Graham had this very strict definition of the difference between investment and speculation.
Right.
And investment, according to Graham, must, #1, promise safety of principal, and #2, promise an adequate return. And this has to be based on thorough analysis. Bitcoin fails the first test, safety of principal, right out of the gate.
Because it has no underlying cash flow.
Exactly. It doesn't pay a dividend. It doesn't have earnings. There are no factories, no sales teams, no products being sold to customers. Its price relies entirely on what's called the greater fool theory.
Explain that for us.
The greater fool theory is the idea that you can buy an overpriced asset because you believe you can find someone else, a greater fool, who will buy it from you later for an even higher price. Your profit depends entirely on finding that next person.
It's a game of musical chairs.
It is. And the Syracuse paper compares it, as you said, to the Beady Baity craze of the 90s or the Dutch tulip media of the 1600s. When you buy a stock, say a share of Apple, you own a tiny piece of a real business that produces real things and generates real profits. When you buy Bitcoin, you own an entry on a digital ledger. That's it.
And there was a really interesting point in our research about the types of people trading Bitcoin. A study from ResearchGate modeled the market participants and found there are basically 2 camps, right?
Yes, this was a heterogeneous agent model. Really fascinating stuff. It found that one camp is the tech-savvy investors. These are the true believers, the ones who buy based on the potential future utility of the technology itself.
The long-term holders.
Right. But the other group, the speculators, who make up a massive chunk of the daily trading volume, are purely momentum traders. They buy when the price is going up, and they sell, often in a panic, when the price is going down. This behavior, it just exacerbates the crashes.
So it's a feedback loop. The price starts to drop, the speculators get scared and sell, which pushes the price down even faster, which scares more speculators.
Exactly. A downward spiral. In a high volatility regime, the speculators pile on, making the swings even more violent. For a senior looking for income and stability, you are essentially stepping into a cage match between complex algorithms and emotional momentum traders. It is not a fair fight, and it certainly isn't a strategy for preserving wealth.
It feels like putting your retirement savings on the roulette table in Vegas.
That's the analogy from the paper. One is a game of chance, the other, an investment, is supposed to be based on productive output.
And speaking of 2026, we have seen a major shift in the market dynamics just recently, something we're calling the decoupling.
This is critical for understanding where we are right now. For a long time, really up until the second half of 2025, Bitcoin and the NASDAQ, specifically the QQQ ETF, which we'll talk more about, they moved in lockstep.
They were correlated.
Highly correlated. If tech stocks went up, Bitcoin went up. It was all just a risk-on trade. With investors felt bold, they bought both. But if you look at the charts from late 2025 and into January of this year,
He broke up.
they broke up. The correlation dropped significantly. We saw tech stocks continuing to climb, driven by actual earnings reports and this massive AI infrastructure boom we mentioned. Meanwhile, Bitcoin either lagged or dropped.
What does that tell you?
It signals that the so-called smart money, the institutional investors, are starting to differentiate. They're rotating capital. They are taking money out of purely speculative digital assets and pouring it into productive digital assets. They're treating crypto as maybe a small diversifier with very strict limits, not a core holding.
Which brings us perfectly to part two. If Bitcoin is empty in terms of cash flow, let's talk about the asset that is full.
Yeah.
We're calling it the new oil.
Right. But the sources make a really interesting distinction here, which is important. Oil, the black stuff in the ground, it gets used up, you burn it in your car, it's gone.
It's a depleting resource.
Exactly. But data digital oil is non-depleting. This is a key concept from a government analysis on data asset valuation. You can use the same data set to train an AI model, then turn around and use it again to target an advertisement, and then use it a third time to improve a product feature. It doesn't get used up.
In fact, it often becomes more valuable the more you refine it, right?
Precisely. The more you analyze it and connect it to other data, the more powerful it becomes. So when we talk about investing in big tech, we aren't just investing in companies that sell phones or software licenses. We're investing in these monetization machines that run on this incredible non-depleting fuel.
Let's break that down. What are the mechanisms of that monetization?
Well, let's look at the intellectual property, or IP, aspect first. We have a report from Patent PC that breaks down how companies like Apple, Microsoft, and Google actually monetize their IP. It's so much more than just selling a device. It's about building an entire ecosystem.
The famous walled garden.
The walled garden is a massive cash flow generator. Apple bundles the hardware, the iPhone with the services like the App Store and iCloud and the branding. Once you're in that ecosystem, the switching costs to go to an Android phone are really high.
All your photos are in iCloud. All your apps are from the App Store. It's a hassle to leave.
It's a huge hassle.
Mm.
And that creates a powerful economic moat. Or look at a company like Qualcomm. They have a licensing model where phone manufacturers have to pay them just to use their wireless technology patents, even if they don't buy a Qualcomm chip directly. It's like a tax on the entire mobile industry.
And then there's the trade secret aspect. I was really surprised to learn that Google's search algorithm isn't actually patented.
That's a brilliant strategic choice. If you patent something, you have to disclose exactly how it works to the public, and that patent eventually expires after about 20 years.
And then your competitors can copy it.
Legally. But a trade secret, like the formula for Coca-Cola or Google's search ranking algorithm, is a black box. As long as they can keep it secret, it generates potentially infinite returns. Competitors can't copy it because they can't see inside. This is a massive hidden asset that doesn't even show up on the balance sheet in traditional accounting, but it drives almost all of the company's value.
So let's talk about the cold, hard cash this generates. Because unlike Bitcoin, these companies are literally printing money. We have some average revenue per user, or ARPU, stats here. These are pretty mind-blowing.
These numbers are the antidote to the greater fool theory. This is real value. Let's start with Amazon. For every Prime member, they generate approximately $400 per year in revenue.
$400 from one person.
From one person, through a combination of the subscription fee, purchases, and using their other services. Then you look at Google. They generate around $280 per year per user.
And that's mostly from advertising, right? When I search for something, companies pay to show me ads.
Almost entirely. It's from your searches, the videos you watch on YouTube, the locations you look up on maps, and Meta, Facebook, and Instagram. They generate about $120 per year per user.
So when I buy a share of Amazon, I'm not just buying a piece of a website. I'm buying a stream of that $400 coming in from hundreds of millions of people year after year after year.
Correct. You are buying a piece of a highly predictable, productive economy. You are capitalizing on fundamental human behaviors: shopping, searching, socializing. As long as people continue to do those things online, these companies generate cash. That is safety of principle in the Graham sense. There's a floor under the stock price that Bitcoin simply does not have.
Okay, so we've established that data is the productive asset. But why is 2026 such a specific turning point? This brings us to part 3. The AI infrastructure boom. The headline number here is, it's just staggering, $530 billion.
That is the projected capital expenditure, or CapEx, for big tech in 2026 alone. This is according to a deep dive from the IO fund, $530 billion.
Put that number in perspective.
It's larger than the entire gross domestic product of many mid-sized countries. It's more than the entire U.S. interstate highway system cost to build, adjusted for inflation. This isn't just maintenance spending. This is a factory build-out on a scale we have never seen before.
We usually think of factories as smokestacks and assembly lines, but these are data factories.
Exactly. And this is where the comparison to Bitcoin mining gets really, really interesting. Bitcoin mining, as we know, consumes massive amounts of energy. But what is it for? It's to solve a complex math problem,
For what purpose?
to create digital scarcity, to prove that a coin is rare and can't be counterfeited. It's an extraction process, like digging for gold. You expend a lot of energy to get a scarce commodity.
But the AI data centers.
The AI data centers also consume massive amounts of energy, but they're using it to produce intelligence. They're taking that digital oil, all the data they've collected, and running it through these massive compute clusters. And the output is, well, it's everything. It's software code, it's drug discovery, it's customer service automation, it's creative content. It is a production process, not just an extraction process.
And the scale of this spending, this $530 billion, it creates a moat, doesn't it? I mean, a startup in a garage can't spend $50 billion on servers next year.
No, they can't. And that's why the big tech wins thesis is so powerful for the long haul. Only Microsoft, Google, Amazon, and Meta can afford to build these data factories at this scale. It creates a barrier to entry that is almost insurmountable for anyone else. They are building the picks and shovels and the gold mine all at the same time.
And they aren't just buying the shovels from NVIDIA anymore, right? They're building their own, the custom silicon angle.
Yes, this is a huge, huge development. We're seeing Google with its TPU, Amazon with Trainium, Microsoft is developing its own chips. Why does that matter for an investor?
I assume it's about cost.
It's all about margins. If you have to buy all your chips from NVIDIA, NVIDIA keeps a hefty profit margin on each one. If you design and build your own chips like Google's Tensor Processing Unit or Amazon's Trainium, you control your costs.
Right.
Over the long term, this massively improves the profitability of these AI services. It means they can offer AI cheaper than anyone else and still make more money on it. It's a brilliant long-term strategic play that we are seeing come to fruition right now in 2026.
And it locks in their dominance for the next decade.
At least. They are building the foundational infrastructure for the next wave of the economy, and they are doing it with their own custom tools.
Okay, so I'm convinced. I'm a senior, I want stability, I want growth, and I see that big tech is the productive asset. But I also know the golden rule of investing. Don't put all your eggs in one basket. I shouldn't just go out and buy a bunch of Google or Amazon stock directly.
No, absolutely not. Individual stock picking is risky, even with great companies. For the learner profile, for the senior investor, you want the whole basket. You want an ETF, an exchange-traded fund.
Which is where it gets confusing again. So let's do the ETF showdown. We have three big contenders that people always talk about: QQQ, VGT, and XLK.
This is where it gets really interesting, and frankly, where a lot of well-intentioned investors get tripped up by technicalities they don't even know exist.
Let's start with VGT. That's the Vanguard Information Technology ETF. I mean, Vanguard is a household name, a trusted brand. If I buy VGT, I'm buying tech, right?
You would think so. It says it right on the tin. But here's the trap. VGT, and funds like it, are built to follow a specific set of rules called the GICS sector classifications.
GICS?
The Global Industry Classification Standard. It's a system run by MSCI and S&P that basically puts every company into a specific bucket, like financials, healthcare, or information technology.
Okay, seems reasonable.
It was, for a while.
Yeah.
But the people who make those rules decided a few years ago that some of the biggest tech companies in the world aren't really tech anymore.
Which ones?
Google and Meta. They decided that since they make most of their money from advertising, they should be classified as communication services.
So they're in the same bucket as like Verizon or Disney.
Exactly. And Amazon. Because it's the biggest retailer in the world, they classified it as consumer discretionary, along with Home Depot and McDonald's.
Wait, hold on. Let me get this straight. If I buy the Information Technology ETF from Vanguard, a fund, I think, is giving me exposure to the biggest tech trends.
Zero. Not a single share. You are missing 3 of the magnificent 7 companies that are at the absolute heart of the data and AI economy.
That seems borderline deceptive. It's just fundamentally counterintuitive.
It is, and it has a huge knock-on effect. Because VGT has to exclude those massive companies, it ends up being incredibly concentrated in the ones that remain. So if you look at the holdings of VGT, you might find that just three companies, Apple, Microsoft, and NVIDIA, make up over 45% of the entire fund.
45% in just three stocks? That's a huge concentration risk.
Yeah.
If one of those three has a bad quarter, your whole portfolio catches a cold.
A very bad cold. And the same problem applies to XLK, the Technology Select Sector SPDR fund, another huge popular tech ETF.
And it follows the same GICS rules.
The exact same rules, so it has the same blind spots. It's great if you only want exposure to hardware and software companies, but if you want the digital oil companies, the ones monetizing data through ads, search, and e-commerce, you're completely missing out.
So that leads us to the winner of this showdown, for our purposes at least, QQQ.
Invesco QQQ
Yeah.
is one of the oldest and biggest ETFs out there. And its magic is that it tracks the NASDAQ 100 index. And the NASDAQ 100, well, it doesn't care about those arbitrary GICS sector labels.
So how does it pick its stocks?
It's much simpler. It just takes the 100 largest non-financial companies listed on the NASDAQ stock exchange, period.
So what's in that basket?
Everything you want. You get Apple, Microsoft, and NVIDIA. But you also get Amazon, Google, and Meta. You get Tesla, you get Broadcom, you even get some biotech companies and other innovators. It is a much more complete picture of the modern innovation economy.
It feels like QQQ is capturing the entire data economy rather than just the narrowly defined tech sector.
That is the perfect way to put it. It's buying the infrastructure of the 21st century. And for a senior investor, there is another massive advantage to holding these companies via QQQ versus holding Bitcoin. It's something we touched on, but it's worth hammering home. Income and capital return. Bitcoin pays you nothing. You hold it and you hope. That's it. But Apple and Microsoft, they have massive dividend programs that are growing every year. And they have massive share buyback programs.
Explain what a buyback does for a shareholder.
So when a company buys back its own stock, it reduces the total number of shares outstanding. This makes each remaining share more valuable, representing a larger piece of the company. It's a tax-efficient way to return cash to shareholders, and it directly supports the stock price.
It puts a floor under it.
It provides a huge, steady source of demand for the stock. In a volatile market, knowing that Apple's in the market buying back billions of dollars of its own stock provides a cushion. It dampens the volatility. QQQ itself yields a small dividend, but the underlying companies are these cash-generating machines that are constantly returning that cash to you, the owner. That is crucial for anyone relying on their portfolio for retirement income.
So QQQ is the vehicle. I think you've made a very strong case. But I want to play devil's advocate for a minute. We've been pretty hard on Bitcoin, but is big tech totally risk-free?
Sure.
Are there no clouds on the horizon? I'm hearing rumblings about something called data debt.
This is a very, very important counterpoint. No investment is risk-free. And yes, data debt is a real emerging risk for these tech giants. Anyone telling you otherwise is not giving you the full picture.
What does that mean exactly? Data debt.
Think about hoarding in the physical world. If you just fill your house with stuff, eventually it becomes a liability, right?
Yeah.
You can't move, it's a fire hazard, it costs money to store. The same thing is starting to happen with data.
Okay.
Companies have been hoarding exabytes of data for years, thinking more is always better. But data has gravity. It requires massive, expensive storage, it attracts security risks, hackers want to steal it, and it attracts regulatory scrutiny. Governments around the world want to control it and fine you if you misuse it.
So just having the data isn't enough. It can become a burden.
It's exactly. A report from Deloitte highlights that data debt consists of all the implied costs of cleaning that data, securing it, maintaining it, and ensuring it's compliant with privacy laws like GDPR in Europe. If a company has dirty data, unorganized, duplicative, unsecured, it becomes a massive financial anchor weighing them down.
So the winners in QQQ aren't just the ones with the most data, but the ones with the cleanest and best managed data.
Precisely. They are the companies that are best at refining that crude digital oil into high-octane fuel efficiently. And the reason we like the QQQ companies, the Googles and Microsofts and Amazons, is that they're the best in the world at this. They are literally using their own advanced AI to clean and organize their own data. They're turning that potential liability into their greatest asset.
While smaller companies,
Or even big, older companies that are just hoarding data without a plan, they are going to drown in data debt. The costs will eat them alive.
that's a really nuanced point. It's not just data is the new oil, it's refined data is value. Raw data is a liability.
And that ties right back to the volatility comparison. Even with data debt risks and regulatory risks, a stock like Microsoft might drop 20 or 30% in a bad year. We've seen it happen. But because they have billions in earnings, because they have this incredible data refinement capability, there is a floor. Investors eventually step in and say, hey, this company earns $10 billion a quarter. The stock has fallen too far. It's too cheap.
Whereas with Bitcoin,
With Bitcoin, as we said, there is no earnings floor. There is no cash reserve. If sentiment turns, if the greater fool disappears from the market, there is no mathematical reason for the price to stop falling until it gets very, very close to zero. That is the fundamental difference in the risk profile you are taking on.
wow. Okay, so we have covered a lot of ground here. We started with the Bitcoin reality check, extreme volatility, no intrinsic value, purely speculative.
The store of anxiety.
A store of anxiety. Then we moved to the digital oil thesis, how big tech monetizes these incredible non-depleting data assets.
Right. And then we looked at the massive AI factory build-out that is creating this almost unassailable moat around a few key players.
We identified QQQ as the superior vehicle for accessing that entire ecosystem because it doesn't fall into the GICS sector trap that VGT and XLK do.
A crucial, practical takeaway.
And we acknowledge the real risk of data debt and how the winners are the ones who can manage that debt effectively.
It's a comprehensive case for why, here in 2026, the smart money, and more importantly for our listeners, the safe money, is betting on productivity over scarcity.
So as we wrap up, I want to leave our listeners, especially the seniors who are looking at their portfolios right now, maybe feeling that anxiety we talked about, with a final provocative thought.
I think the most powerful image is the one we touched on earlier. If we accept this premise that data is the new oil, then you have to ask yourself a very simple question.
What's that?
Do you want to own the commodity that just sits in a barrel or in a digital wallet, doing absolutely nothing, just sitting there? Its only value based on the hope that someone else will buy it from you for more. Or do you want to own the refinery?
The refinery that takes that raw, messy resource and turns it into the gasoline, the jet fuel, the plastics, the things that actually power the entire world.
Exactly. Owning the refinery, owning QQQ, means you own the engine of the modern economy. You get paid while that engine runs. Owning the barrel, owning Bitcoin, means you are just speculating on the price of storage.
For a senior investor, the choice isn't just about growth versus value, it's about sleep.
Sleep is a very valuable commodity, probably the most valuable one in retirement.
And QQQ offers the growth of the AI revolution, but it's tethered to the stability of actual business earnings, cash flows, and capital returns. You can sleep when you own Apple and Microsoft and Google. It's much, much harder to sleep soundly when you own an asset that can drop 80% because of a rumor or a tweet.
Well said.
That's it for this deep dive. We hope this helps you navigate the noise of 2026. Remember, check your ETF holdings, understand what you actually own, and don't let the headlines drive your retirement strategy. Thanks for listening.
Stay curious and stay informed.
We'll see you next time.